Lesson 10, Trading Days versus Trending Days. Before we get started, I'd like to point out a couple things. Up in the top left-hand corner, you will see a sign that says important information. Throughout this lesson, this sign will appear on certain slides. That slide will be of somewhat great importance, perhaps a trader's tip that can really help you out in trading. The next thing is that in the bottom center of this page you will see there is a number. That is the number of the slide that we are on. That number will match up the number in your workbook. If you lose your place, just look at the slide that I am on and match it up with your workbook. And we should all be going through this together. There are 16 lessons on trading the Forex that can participate greatly in helping you. These lessons do focus in on technical analysis. They can participate in helping you in other products as well. Stocks, commodities, any product that you can pull up a financial chart. These lessons on technical analysis can participate in helping you. One of the most profound statements I've ever heard: successful traders will do what unsuccessful traders can't and won't do. Successful people are different for a reason. They do things differently than unsuccessful people. Successful traders are different for a reason. They have a tendency to properly educate themselves on how the market works, and then they have a tendency to buy into a clear set of disciplines that they will obey as they trade. The 21-day 3% rule basically states that the human mind forgets 80% of the knowledge it acquires within 3 days. Over the next 18 days, it continues the loss of information until it settles at retaining only 3% of the original acquired information. That is why you hear the statement, if you don't use it, you lose it. If you don't replay this lesson until you clearly understand it and apply it, you will lose it. I point out this fact so that as you trade, you can become successful and have access to these lessons and play them over and over again until you yourself can place yourself in a position to have a fighting chance at being successful at trading. By the end of this lesson, you will understand that the markets can only move up, down, or sideways. And you will learn how to read a trading chart and be introduced to the technical side of dealing with a trading day and a trending day. You will learn how to trade a trading day. You will learn how to trade a trending day. You will learn that as you create a trading plan, you will need to financially protect yourself at support or resistance on each trade. Now, before we get started, I want to review reading these trading charts and placing your orders. We are watching Japanese candlesticks, which monitor the open, the high, low, and close, and that there's two types of candles. One is a bullish candle, which the close is higher than the open. The other one is a bearish candle, where the close is lower than the open. Bullish candles represent that the market is going up. Bearish candles represent that the market is going down. The wicks or lines on each side of these candles represent the high of that time period and the low of that time period. We are watching a bid chart. It is monitoring the bid price. There is a bid and an ask at all times. The spread between the bid and the ask is anywhere from 3 to 10 pips. In currencies, there are spreads in other financial products as well. Be aware of your spreads, and remember that we buy on the ask and we sell on the bid. This is important information. The reason why is because when you buy at the market, or you've entered the market on a buy, whether it's a market order, a stop, or a limit, when you place a buy, you should have two sells, one for profit and one for loss. But when you buy on the bid, you will be when you buy on the ask, you'll be selling on the bid. And because we are watching a bid chart, and because as these candles are growing and being formed, they are only monitoring the bid price, which means if your sell limit is on the bid, then as the market rallies, the candle will need to hit your bid price, just like the candle will need to hit your bid price on your protective stop loss to be filled. The opposite takes place when you enter the market on a sell. We sell on the bid, which means that would be the price you enter at, 107.30, and your protective stop loss order will be on the ask, which means as the market rallies, the ask price will hit your stop order before the bid price. If the candles never make it to your ask price and then they fall, you still have a high percentage chance of being filled because the ask will hit your buy stop before the bid will. Conversely, the same will take place. The candles will need to fall and go through your ask price before your buy limit is filled. So please remember that. The types of orders that we use are market orders, which means that's an order that is placed right at the market, right at the bid or the ask. A limit order, which is an order placed that you will be filled at that price or better, and a stop order, which is an order placed at a certain price which will be filled at that price or better or worse, and may incur slippage, but stop orders turn into market orders when touched. So here's the rules as you trade. If this is where the market is, any order that is placed above or below that market will be called an open, unfilled, or working order. If you place a buy above the market, that's a stop order. If you place a sell above the market, that's a limit order. Those are the rules. If you place a buy below the market, that'll be a limit order. If you place a sell below the market, that'll be a stop order. Those are the rules. Here are other rules that I think you should abide by. This is important information. Every buy should have two sells, one for profit, one for loss. I say that if you enter the order placed on a buy and you want to cancel and replace and chase the market, place a sell exit order for profit somewhere, create a wish list, but every buy should have two sells, one for profit and one for potential loss. Remember, when you buy, your stop order goes at the last low, and every time you sell, you should have two buys. The greatest part about trading currencies is if the market starts to react, dip, or fall, you can make money trading as a bear, taking a short position. But remember, whenever you sell, you need to have two buys, one for profit and one for loss. So as you enter the market, your stop order goes at the last high or level of resistance. Your buy limit for profit will need to go below your entry. You will still be buying low and selling high. OCO means whichever the market hits first, it will cancel the other order. If you enter the market buying, as you place your limit for profit and your stop for loss, whichever the market hits first, it will cancel the opposite order. If you sell first, you will need to place an order for profit and an order for loss. Whichever the market hits first, it will cancel the opposite order. In canceling and replacing, please once again keep in mind only cancel and replace to the last low after the market has made a new high. That makes a big difference by staying back, allowing the market to wave as it moves. The same rule applies as the market is going down. As the market is going down, only cancel and place to the new last high after the market has made a new low. Bulls enter the market buying first. They tell the world they want the market to rally, go up. They want a bullish environment. They will need to buy low and sell high, buy low and sell high. Trading currencies offers a great opportunity because of the leverage. These three moves that were based on a trading signal offered 290 pips in profit. At $10 a pip, that equated to $2,900. Trading 10 lots equated to $29,000. The greatest part about trading currencies is because of that leverage, you can really write your own financial ticket. Bears, they do the opposite of bulls. They enter the market selling first. As you enter selling first, in order to make a profit, you will need to buy at a lower price. If you buy at a lower price, you then bought low and sold high. That is the key to successful trading, is buying low and selling high. These two moves created 350 pips in profit. One lot turned out to be $3,500. 10 lots is $35,000. Be that as it may, whether the market rallies or reacts, you can make profit as a trader on the Forex if you trade in the right direction and know what you're doing. Technical traders learn to read charts. Technical traders read charts like doctors read x-rays. To the trained eye, charts are telling a story. Technical analysis gives the traders a high probability of knowing where the market is going to go. We all make money by predicting the future, not the past. A chart is a chart is a chart. The greatest part about technical analysis is that it is applicable to any financial product, anywhere you can pull up a chart. And once you've been educated on technical analysis, you can start to control your financial future. Reviewing lesson 2 will also help us in this lesson. Remember, highs have 2 candles to the left and 2 candles to the right that are lower than the wick or the body of the candle high. Not all highs are levels of resistance. Here's this important information. Only higher highs that are being created are new levels of resistance. Please review lesson 2, which is on support and resistance and the financial game. It is a great lesson that focuses in on teaching you how to spot all your highs and lows, levels of resistance and support. A low is a body of a candle or a wick low that has 2 candles to the left and 2 candles to the right that are higher than the wick low. Not all lows are levels of support. Only lower lows that are being created become new levels of support from anywhere the market is currently being traded. Whenever you're looking for resistance or support, you start at the right of the chart and you work backwards to the left. To find resistance, you need to find a high that is higher than the previous high, as if you are stepping up a ladder. Please don't forget that. Same with support. You need to find lows that are lower than the previous support. It's like walking down a set of stairs. Resistance, you walk up a set of stairs. Support, you walk down a set of stairs. You need to get your eyes to visually be able to look at a chart, get them trained to where they can just see where the current market is, and without even drawing a line, have your eyes be able to spot all your levels of resistance and support. That is part of learning technical analysis. I'd like to do a quick review on trends and trend lines, which is lesson 5. Remember, the market moves in price swings and in waves. An up price swing starts at a low and stops at a high. See how we have the lows, 2 to the left, 2 to the right, stops at a high, 2 to the left, 2 to the right. That is an up price swing. Uptrends are nothing more than higher highs being created and higher lows being created. This low is higher than that low. This high is higher than that high. Higher highs and higher lows constitute an uptrend. When you spot an uptrend, you draw your trend lines across the lows. Traders are trying to buy trend line bounces. See how we draw our trend lines across the low? The market has a tendency to bounce at these trend lines. There are 3 trend lines we're monitoring, an inner, an outer, and a long term. Please keep that in mind. In lesson 5, we focus in on how to trade these trend lines. Down price swings work the opposite. They start at a high and stop at a low. Look at how the market, as it is trending down, creates waves. Those waves are called down price swings. Now, when the market is making a lower low and a lower high, it is creating a downtrend. Downtrends are lower lows and lower highs. Remember, your trend is your friend until it bends, but The only way you'll be able to spot that it's bending is to draw the trend lines across the highs. Draw all your trend lines across the highs of resistance. Excuse me. There are three primary downtrend lines forming in any trend. Once again, it's the inner, the outer, and the long-term outer trend line. I want to review price swings and extensions with the Fibonacci numbers briefly. This is lesson 7, which goes into great detail about this, but remember, this business in its entirety is found right here on this page. This is an up trend price swing and extension. This is a rally, this is a reaction, this is a rally. The market moves in swings and extensions as it moves. As the market rallies, it slowly retraces as it hits a numerical number. Once again, I go into detail about this in lesson 7, the price swing and the Fibonacci numbers. Please keep in mind, this is not an extension until it has taken out its previous high. Let's look at this on a chart. See how the market rallied, it retraced, U-turned, bounced at a Fibonacci number, and made a new high. When it makes a new high, it is now working on the extension. In lesson 7, we talk about the market being governed by natural laws, and that the world is governed by natural laws. And we talk about Fibonacci and his numerical sequence, which is the sum of the previous two equal the sum of the next. 2 and 3 equal 5, 3 and 5 equal 8, 5 and 8 equal 13, 8 and 13 equal 21. We get involved in the ratios. As we hit certain numbers and you start dividing them, you come up with certain ratio numbers. When you take 89 divided by 144, or take 144 divided by 233, you come up with 0.618, and we came up with, after doing all our division, we came up with important ratio numbers, which was 38250,618, and we aligned them to a 1.618 extension, and 786 was aligned with the 1.27 extension, or 127%, and we realized that these Fibonacci numbers are hidden potential levels of support in an upswing, and that if the market, after it has rallied and it has now started to retrace, bounces at a 38250 or 618, it is going to go to a 1.618 or 162%. See how it rallied, retraced back, bounced at a 382, and went to the 1.618 extension. All these are the retracement values. These are the extension values. Let's look at when the market retraces all the way back to the 786, it will only go to the 1.27. See how the market rallied, retraced to the 786, and that it slowly went to the 1.27 or 127%. We also learned that the market moves at different speeds. I point this out because this is going to play a part in our lesson today. That when the market is bouncing at the 382, it is moving very fast and aggressive, and there is a strategy how to enter the market at the 382. That strategy is found in lesson 7, the price swing and Fibonacci numbers. Now, the down price swings work exactly the same. As the market moves down, it is waving and swinging, and it goes to extensions. The entire downswing and extension is part of a Gartley and can play a part. The Gartleys, which are a great lesson, is lesson 13. It teaches you how to trade and find convergences. Let's look at this downswing and its extension. That works exact opposite as an upswing. Now, Fibonacci ratios are hidden levels of resistance in a downswing. You learn how to spread your Fibonacci's in lesson 7. If by chance you have any questions whatsoever about how to spread your Fibonacci's, please review lesson 7 or go into the chat room and ask us exactly how to do this. We will help you. If you would like phone support, give us a call. We'll walk you through how to spread your Fibonacci's. But remember, in a down price swing, if the market bounces at a 382.50618, it should go to the 1.618 extension. See how the market is moving very aggressively and fast, bounced at the 382, went to the 1.618 extension. There it stopped and bounced again. It is amazing how these Fibonacci's work. If it bounces at a 786, it'll only go to a 1.27 extension. Look at how the market bounced at a 786 and only went to a 1.27 extension. Please keep in mind, don't cancel and replace until the market has made a new low or until it has bounced off a 786. Do not cancel or replace if it bounces off a 618, because the market sometimes goes sideways before it goes to its appropriate extension. Downswings move at different speeds as well. 382 bounce is very fast and aggressive versus the 786 bounce, which means the market is slowing down. And the reason you want to trade 618 and 786 Fibonacci bounces in the direction of the trend is because if the trade doesn't work, your losses will be small. Keeping in mind that you place your stop orders at the last high if you are selling, the last low if you are buying. If you listen to the market with your eyes, look at where the market has been and it'll tell you where it's going. If we were buying this market at a 618 bounce, which the market did bounce here, it came down to the 618, bounced, but U-turned and came back to the 786, our original strategy was to buy the 618 and ride it to the 1.618 extension. Now that it U-turned and came back to this 786, which this move right here is called a Gartley. That Gartley is lesson 13. Great information in that lesson. Look at how it came back, bounced at the 786. Now that it bounced at the 786, if we listen with our eyes, it'll tell us where it's going to go. Look at how it only went to the 1.27, never made it up to the 1.618. We need to understand where the market has been in order to understand where it's going to go. Now let's get into lesson 10, which is trading days versus trending days. If you don't understand any of the foregoing, please review the lessons that I pointed out, and if you're still having any sort of difficulty, please feel free to give us a call. We'll walk you through some of these lessons in our customer service department. There are 3 trading sessions every 24 hours. One is that the Forex opens and closes only one time a week. It opens at 7 p.m. Eastern Standard Time on Sunday evening and closes at 4 p.m. Eastern Standard Time on Friday. Every 24 hours, there will be 3 trading sessions that will take place. The first session starts at approximately 7 p.m. Eastern Standard Time and goes till 6 a.m. Eastern Standard Time, which is the Asian market. Now that Asian market includes China, Hong Kong, Taiwan, Taipei, Korea, Japan, all the way down through Polynesia and Australia, New Zealand. That is the Asian market. They go until 6 a.m. Eastern Standard Time. They overlap Europe by 4 hours. Europe opens up at 2 a.m. Now when I say Europe, I'm talking about Germany, France, Italy, England, Switzerland. All those European countries are considered Europe. And they open up at 2 o'clock a.m. and close at 11 a.m. Eastern Standard Time. The U.S. market opens up at 8 a.m. and it overlaps the European market by 3 hours. Now when I say the U.S. market, I'm talking about all of Canada, the United States, Central America, South America. That is the U.S. market, and it closes at 5 o'clock p.m. And then the market starts all over again. This cycle goes for 5 complete days, starting Sunday evening, closing at 5 o'clock on Friday. Now, the market performs differently during each trading session. Each trading session will either be what's called a trading day or a trending day. Now, a trading day session has no fundamental announcements, it will be what's called slow in price movement. You won't get much volatility. Market movement during this session will create a trading range of about 60 to 90 pips. Now, lesson 14 focuses in on beats. You may want to really understand that because beats play a big part in trading and trending days. Now, trading session will finish or close near the opening price of that session, which means you need to understand and know the times that those markets open. Again, the Asian market opens at 7 p.m., the European market opens at 2 o'clock a.m. Eastern Standard Time, and the U.S. market opens up at approximately 8 o'clock Eastern Standard Time. Please remember those times, because the trading session on a trading day will finish or close near the opening price of the next session. And the market will create what's called an upper bell curve, a lower bell curve, or may perhaps just go sideways during that session. The best way to see this is on a 30 or 15-minute chart. Now let's look at this 30-minute chart. See, this is a Euro 30-minute chart. These are trading days. Look at how it looks as though the U.S. markets, they opened up. Look at how they created a lower bell curve on this day. On this day, an upper bell curve. See how it looks just like a bell, but upside down. See how it starts here, rallies. Look at how the market opened here, went and created a lower bell curve, only moved 60 pips down and then 60 pips back up and then closed. Then all of a sudden, Japan opened up, it went sideways. Then look at how Asia opened up, it created a lower bell curve. Europe opened up, or US opened up, created an upper bell curve. Look at this one. Instead of going 60 pips up and 30 pips down, this one went 90 pips up and 90 pips back down. This is called an upper bell curve. Look at on these days, there's no trading fundamental announcements. These are the Asian markets now. Look at how the Asian markets went sideways from time of opening. This is when the prices opened right there. Market rallied up, 40 pips, came back down and closed near its opening. Just like these, the previous day, look at how all these closures were near the opening. Market closed somewhere near the opening. Market closed near the opening. Here, look at how on this day, Asia opened up, went sideways, closed somewhere near where it opened. On this day, opened up, went sideways, closed where it opened. Look at the European markets. European markets went 40 pips up and then back down, created an upper bell curve. Look at here. Went down, came back up, created a lower bell curve. Here came down, 40 pips, went back up, lower bell curve. See the lower bell curves? Now, a trending day session is completely opposite. It has fundamental announcements. The trading will be fast and aggressive. Market movement during the session will create large trading ranges, 120 to 300 pips. Once again, lesson 14 is on beats. Market will create either an uptrend for the day or a downtrend for the day. The trading session will not finish or close near the opening price of the session. Now let's look at this. These are days when the market has fundamental announcements. Look at this chart. It is 100 pips here, 200 pips here. This difference here is 200 pips. Remember, fundamental announcement hits. The market moved 200 pips up and then came back down. It closes nowhere near the opening price. Look at on this day, fundamental announcement. Market rallies and then stays there, trends up. Look at this day, market rallies, stays there. These are the days that if you trade without a protective loss stop and you're trading in the wrong direction, you will probably be liquidated on these days. Because when they break out, which is all about lesson 9, consolidation and fundamental announcements, when they break out, They don't return back to the opening price. So it's very important. Look at these fundamental announcements on the European session. Look at how it broke out to the south and stayed there. Look at here. Another fundamental announcement. Breaks out and does not return back to the opening price. Now let's walk through this trading exercise. I would like you to find trading days versus trending days on these following charts. Put the machine on pause and draw out trading days versus trending days. This is what it should look like. These are trading days. Here's a trading day. Here's a trading day, upper bell curve. Now, fundamental announcement, you have a trending day. Find trading days versus trending days. Put your machine on pause. Look at these trading days versus trending days. This was obviously a trading day as well. Market consolidating, waiting for a breakout. Find trading days versus trending days on this Japanese yen chart. Put your machine on pause. Is this what you see? A breakout fundamental announcement, an upper bell curve here, upper bell curve here. These are trading days versus trending days. Find them on this Swiss franc 15-minute chart. Put your machine on pause. Is this what they look like? Breakouts, trading days. This is a trending day, a trading day, a trending day. Look at another trending day, a trading day. Remember, on trending days, the market is going to trend. That's why it's called a trending day, and it's not going to return back to the opening price. A trading day is where the market will create an upper, lower bell curve or just go sideways, and it will close somewhere near where it opened up during the beginning of its trading session. Now, I'd like to do a trading exercise. Let's trade a trading day. Turn on your trading software, which has been created for you to practice trade and accumulate profit before you open up a new account. Here's how you trade a trading day session. There will be no fundamental announcements on that day. Trading will be slow. Market movement during the session will create a trading range between 60 and 90 pips, and the trading session will finish or close near the opening price of that session. Market will create an upper or lower bell curve, as I said before, or just go sideways. Now here's the rules. Go to forextips.com and make sure there are no fundamental announcements. Draw a horizontal line at the opening price of the session. Find and draw all your trend lines, inner, outer, and long term. We focus in on that on lesson 5. This will help you determine if you're in an uptrend or a downtrend, or if a trend line's been broken, signifying a potential reversal. Look at where the market is at opening. Now, from opening, anticipate a 60 to 90 pip move up or down from the opening price. See if you can find a 618 or 786 Fibonacci trendline convergence as an upper or lower bell curve forms. If you do, set up a trade and find your levels of support and resistance to locate your protective loss stops. If you can't afford the potential loss, should the trade not work out, then stay out and do not trade. Pull out your trader's checklist and create a trading plan and trade that plan. Now, before you enter the market, you need to decide to be a day trader or a position trader. The term convergence means a location where there is more than one hidden educated reason for the market to bounce, i.e. a trend line, a Fibonacci number, or the beginning, the end, or the height of a bell curve. That's important information to understand. Let's face the facts. All of us want to jump in the market, and we want the market to move our way from the beginning. Look at what education and how the market works can improve that percentage. Now here we turn on our chart. We go to forextips.com. We notice that there is no fundamental announcement. We are then going to anticipate either an upper bell curve forming or a lower bell curve forming. We are trading the European market. No fundamental announcement. There's the horizontal line that we draw at the opening price. European market opens at 2 a.m. Eastern Standard Time, and so we're going to anticipate light movement today. So let's do our homework. We start drawing trend lines. There's our outer trend line. Now if I draw an outer trend line, look at how this works. In anticipation of a lower bell curve, look at how I drew that out. And if the market starts to dip or fall, look at how it would dip and fall, hit the outer trend line, and bounce. Furthermore, look at how it would fall and only go 60 pips. So what I want to do is I want to spread my Fibonacci's from the last upswing, which is this low, to that high. And look at how if I create the lower bell curve, that happens to also be right at the 786 of the latest up price swing, which means I'm going to be buying the tip of this bell curve, but I am also buying a trend line, and I am also buying a 786, and I am placing my stop at the last low. In other words, I have created a scenario, an if-then theory. If the market falls to the trend line, I've learned in lesson 5 that trend lines are where the market bounces. If the market falls to that trend line, it will also be at the 786 of the last up price swing. I learned that in lesson 7, the price swings of Fibonacci numbers. And now I'm learning that on trading days, the market creates lower bell curves, upper bell curves, or goes sideways. The market could go sideways from here. But if, and I'm creating scenarios, if it falls, that's my trade for today. Because if it rallies from here, I don't want to trade against the trend. It could rally from here and take out the previous high. The only safe trade I see so far is to trade a convergence, which is the 786 trend line. And actually, this will also be, because if we take this high to that low, it'll also be a 1.27. That is in the Gartley lesson, lesson 13. I have a clear convergence at the 786 here. So my plan is to be patient and place an order to buy the 786. Now, many times you may want to print out your chart and start drawing on it. See how I drew that lower bell curve? I'm going to set up my trade to buy that lower bell curve convergence with the fib number and trend line in the direction of the trend. That's my only trade. Pull out my trader's checklist. I'm going to set up my trade. Now, trading is all about understanding price movement against time. I will wait with my trader's mantra until the price movement and time match my objective. When you trade as a day trader on a trading day, you should only go for small amounts of profit. Remember, the market only moves 60 to 90 pips. So use logic and your knowledge from all the other lessons on how to trade this. The reason you want to trade, once again, the 618 or 786 bounces in the direction of the trend is because if the trend starts to reverse, your losses will be small. Pull out your trader's checklist, write the date, the currency. We're trading a Fibonacci convergence. We are trading on a trading day. You want to keep all this information for your records. Let's go find all the levels of support and resistance, and let's enter our trade right here in this area. Now, here's where we buy. The market dips and falls. Look at how it fell right to this trend line. See how it fell? Now, because of our education on trading days, it is now forming a lower bell curve. We're buying this trend line. with the stop at the last low lends itself to a tight equity management trade, and let's watch what happens. Now, the reason we find comfort in the numbers that we trade is clearly due from our education. See, I feel comfortable based on my education that the market's going to bounce from here. I'm getting in at an anticipated bounce. I have placed a protective stop loss at the last low. I have quantified my potential loss should this trade not work out. My education on how the market works gives me comfort that it should bounce from here. Let's see what happens. Look at how the market took us in, bounced, and if we went for small profits, 30 pips, now once again this is a 30-minute chart, look at how within 30 minutes it created a nice tweezer bottom, which is lesson 11, trading Japanese candlesticks. Even if we traded the Japanese candlestick or a morning star and evening star based on the tweezer bottoms, we got in right here, and look at how the market rallied. Be that as it may, going for 30 pips, 40 pips on a trading day with it falling 60 pips and rallying 60 pips. Look at how we were in this trade 30 minutes, 1 hour, hour and a half, 2 hours, 2 hours and a half, and we made our 30 to 40 pips profit, or $300 to $400 depending on how much we were going. But look at how we found the bounce and the market moved in our direction from entry based on our education. Now, as you trade using Monopoly Money and the software, your trading software will keep track of your P&L statement. But please fill out your P&L statement on your trading form so you can keep track of what you did. Print out the top chart that you just traded on this trading form. Now, a trending day session has fundamental announcements. Trading will be aggressive. Market movement during this session will create large trading ranges between 120 pips and 300 pips. Market will create an uptrend or a downtrend for that trading session. The trading session will not finish or close near the opening price of that session. Now let's review lesson 9, consolidation of fundamental announcements, for this lesson. Remember, fundamental announcements are reports. A country is a large corporation. There are approximately 14 reports produced in a country that account for the profit and loss of that country. These reports are called fundamental announcements, and each market has its own financial fundamental announcement. Each country has its fundamental announcements. ForexTips.com monitors these fundamental announcements. Fundamental announcements shifts the value of the economy and are the main reason for price change and breakouts, which can create large price swings and trading ranges. ForexTips.com monitors and posts all those fundamental announcements on its website every Sunday evening. Now, all you need to do is go to ForexTips.com, log in as a member. You will get the fundamental announcements monthly, quarterly, and yearly announcements have a tendency to move the market more than weekly announcement. The definition of accumulation, consolidation, bracketing, or sideways movements is the following: when prices establish a tight trading range creating somewhat of equal levels of support and resistance. Let's look at this graphic here, how the market is bouncing off a resistance and support, creating accumulation. This is what it looks like: bouncing off a resistance, bouncing off a support, bouncing off a resistance, bouncing off a support. Accumulation and consolidation and bracketing on the Forex is when prices establish a tight trading range, creating trading ranges of equal levels in support and resistance between 20 and 60 pips over a 6-hour plus period. This consolidation usually takes place right before a major breakout. Now look at how I turned my chart down to a 15-minute chart, let's look at this consolidation. See how it created a tight trading range of 40 pips over a 15-hour period? That's because the market is waiting for consolidation. Here's what it looks like on an hourly chart. See how the market consolidates over 15 hours? So you can see all this previous movement, but now all of a sudden it's calmed down. Markets accumulate, consolidate, and bracket for two main reasons. Prices have reached the value that traders are willing to pay, not more or less, and traders are not trading because they are anticipating or waiting for a fundamental announcement. When traders spot consolidation, they anticipate a breakout. And a breakout is when prices break out of that sideways pattern or accumulate and break through either support or resistance. If the bulls take control, the market will establish new highs. If the bears take control, the market will establish new lows. Now, the breakout, let's look at this graphic, is when the market breaks out of that trading channel. Let's look at this chart. See all these breakouts? Market broke out to the north. Market broke out to the north. Market broke out to the north here. Obviously, we're in an uptrend. Now, when traders spot consolidation or sideways movement, a trading opportunity starts to appear. That trading opportunity is called a straddle trade. A straddle is where you place an order to buy and sell at the same time. But the straddle is called placing an order 15 pips above resistance and 10 pips below support. Now, why 15 pips above resistance and 10 pips below? Why not 15 and 15 or 10 and 10? Is because we're trading off of a bid chart. And you must stay back away from resistance and support prior to the fundamental announcement as to not be taken in before the announcement. Here's your bid chart. Remember that ask price sits between 3 and 10 pips higher than the bid price? If you spot consolidation and sideways movement, first check the economic calendar to see if there is a fundamental announcement. 2, check to see if there's consolidation and if that consolidation is within 20 to 60 pips. 3rd, check to see if it has gone sideways for at least 6 hours prior to the fundamental announcement. Now, place that order 15 pips above the high and 10 pips below those levels of support, just like you see this chart here. We had 15 hours of consolidation. Place that straddle trade. Now, the greatest part about breakouts is when you place that buy above and that sell below, you really don't care which way it goes, because either way it goes, it's going to take you in. Now, when the prices break out of that consolidation or trading channel, either up or down, it's going to take you in. Now, here's what happens. See when it broke out? At this point in time, if we were right here, we still didn't know whether the market was going to break out to the north or to the south. Here, it took us in. Now we start setting up our trade. Fundamental announcements create large trading ranges. Creates trading ranges of anywhere between 120 and 300 pips per trading session. Lesson 14 focuses in on that. Fundamental announcements can create great trading opportunities because here's how you trade them. When it breaks out, you'll place your stop order at the last high, and many times they go huge trading ranges, 180 pips on this trading range, 400 pips after this breakout on this chart. Learning how to properly cancel and replace can really allow you to lock in substantial amounts of profit as the market breaks out. Now, if it breaks out to the south, your protective stop loss order will be at the last high, and if that distance is too far and does not align with your equity management, you probably want to pass on the trade. But see how it broke out to the south? We now place our stop order at the last high. And if it breaks out to the north, your protective stop loss order will be at the last low. If that distance is too far and does not align with your equity management, then pass on the trade. Look at how it broke out to the north. As it took us in here, we'll place our stop order at the last low. When straddling, if the distance between the high and low is too far and does not lend itself to your equity management, you may want to pass on the trade. Now let's look at here. We straddled prior to the announcement, which is 15 minutes prior to the announcement. We place our orders to buy the high or sell the low during the breakout. But if that distance between resistance and support is too great, in this situation, that distance is approximately 125 pips, which means if it breaks out, we'll have to place our order at the last high just in case of a whiplash. You may want to pass on the trade. Now, there's two trading strategies on a trending day. One is called the straddle, and the second one is called a convergence trade. Excuse me. Now here's the trading exercise. Let's trade the straddle. Once again, turn on your trading software and let's see if our education can at least help the market move in our direction from entry. Now before we enter the market, we need to decide to be a day trader or position trader. If you enter the market, canceling and replacing on a trending day, you may want to cancel and replace off of a 30-minute chart. Remember, only cancel and replace to the new last low after the market has made a new high if the market breaks out to the north, and only cancel and replace to the new last high if the market breaks out to the south after it establishes a new low. Now, exit trading strategies, we need to decide what are we going to go for? 40 pips, 100 pips, 150 pips, or are we going to cancel and replace? Please use your logic when placing your limit orders to get out. Keep in mind the financial game, lesson 2, lesson 7, the Fibonacci numbers, and lesson 14, harmonic beats. Rules to trading a straddle: find consolidation in a tight trading range between 20 and 60 pips for the last 4 to 6 hours. Go to forextips.com and find the anticipated fundamental announcement. If there is a fundamental announcement, find where the latest levels of support and resistance are to determine where your buy stop entry will go, 15 pips above, and your sell stop entry will go 10 pips below, and place those orders 15 minutes prior to that announcement. If the potential stop order is too far away in that straddle, you may want to pass on the trade. Pull out your trader's checklist and start to create that trading plan and trade that plan. Here we go to forextips.com. We find out there's fundamental announcements. Once again, monthly, quarterly, and yearly announcements have a tendency to move the market in much larger trading ranges than weekly announcements. Now you start preparing your trade and you start to do your homework, drawing trend lines, figuring out support and resistance and beats, etc. But none of that is going to help you on your entry if you are straddling. That will only help you on your exit. So as we straddle, we place those orders 15 minutes before so we don't get caught up and drug into consolidation, and we wait for the announcement. Now, we wait. Trader's mantra: I'll educate myself on how the market works. I'll learn how to find and place a trade. I will trade with equity management. I will never trade without a protective stop loss order. I will not chase this market. I will be patient, and the market will either meet my criteria or I will not trade. Please fill out your trading form. And here's just a trader's tip, important information. Remember, the length of the consolidation may sometimes equal the distance of the breakout. Look at the length of this consolidation, how it equaled the length of the breakout. You can find out a little bit more about this in lesson 9, consolidation and fundamental announcements. See, The length of the breakout or consolidation equaled the distance of the breakout. Length of consolidation many times equates to the distance of the breakout. The market, we straddled the market. It now took us in. See how the market broke out? Now that it took us in, we need to cancel and replace our stop, cancel that buy order, and now move in and create an OCO, one cancels the other, and place a new tighter stop. Now once again, market broke out on this straddle. Because it broke out on our sell stop entry, we now cancel the buy stop order we had. We now have entered the market. We now need to place a stop order for this sell entry. We'll place our buy stop at the last high. Fill out your paperwork. If you choose to cancel or replace, use this section down here to cancel and replace. Now, if we opted to stay in for 40 pips, this is a 30-minute chart, we were in for about an hour and a half. If we stayed in for 100 pips, we were in for perhaps 8 hours. Either way, look at how the market came down, took out this first level of support, bounced back up, came down, took out the second level of support, bounced back up, and obviously went after another level of support, bounced at that, and is continuing to make lower lows and lower highs. If you are canceling and replacing, you would cancel replace to your latest highs on this 30-minute chart. We had moved from this high to this high, from this high to this high, from this high to this high, from this high to this high. Only cancel replace after it makes a new low. Your software will monitor your P&L statement, but once again, fill out your P&L statement and print out your chart on the top half of this sheet. Now, if the market breaks out of consolidation and returns into consolidation, you will need to reverse your position at your protective stop loss and go with the market. Do not marry a trade. Be quick to turn from a bull to a bear or from a bear to a bull. Listen to the chart, and the chart will tell you the direction that it's going to go. Strategize several scenarios before you trade. Use the if-then theory approach. If the market breaks out and then returns, I'm going to do this. If it breaks out to the south and does this, then I'm going to do that. Look at how the market in this straddle broke out to the north, took us in, returned back in, stopped us out, then started to trend down. Remember, if the market breaks out of consolidation and then returns back into consolidation and starts to go in the opposite direction, the market is reversing. It will more than likely start to form a crown. Find a crown that is lesson 8. Educate yourself on how the crowns work. It's probably also entering into a sell zone or a buy zone, which is lesson 6. Understand these buy and sell zones, these crowns, and go with it. Not all fundamental announcements move the market. Banks are considered fundamentalist traders. When the report is read, they aggressively start trading. If the announcement or report does not have a change in economic value for that currency, the market will not break out and will continue to move in the direction of the previous trend. If an announcement from a previous trading session moved the market to a new value, and now the new announcement reflects its new value and does not move, you probably will have a trading day on a fundamental announcement. Now look at how on this day we ended up having a trading day on a potential trending day. Market didn't move based on a fundamental announcement, and usually when the market doesn't move on a fundamental announcement, it will continue in the direction of the previous trend. The previous trend was up. Look at how the market continued in an upward trend. Whiplashes are created when two fundamental announcements happen at the same time or shortly thereafter. and it creates different economic values. Look at how the market started to break out to the south. Obviously, a fundamental announcement made it break out to the north, but then it still came back into that consolidation. See this whiplash? Perhaps a fundamental announcement made it break out to the north. 30 minutes later, another fundamental announcement made it come all the way across and break out to the south. Here's another whiplash. Whiplashes don't happen that often on the Forex. In a straddle whiplash, your buy and sell orders will both be filled and you will automatically lock in a loss. That is the greatest part about straddling the market. The absolute worst case scenario is your opposing order will become your stop order. If the market fills you on a buy first and then whiplashes, your stop order will become your protective loss stop order. You will have locked in a loss. If it takes you in first on a sell, then whiplashes to the north, your buy stop order will become your stop order for your sell. You will have locked in a loss again. To help you understand effectively how to trade the straddle, please refer to the Financial Game Lesson 2, Lesson 7, the Fibonacci numbers, Lesson 10, Trading and Trending Days, which we're working on right now, as well as Lesson 9, Consolidation and Fundamental Announcements. Remember, refer to Lesson 3 on equity management for the proper placement of your protective loss stop loss orders. When you're buying, your stop order goes to the last low. When you're selling, your stop order goes to the last high. Remember Lesson 16 on trading strategies to maximize your profits when trading. Here's once again is the cancel replace. There are two trading strategies. Remember I talked about on trending days. The second trading strategy is called trading a convergence. We just finished trading a straddle. Now let's trade a convergence and see how this works. Here's the trading exercise. Let's trade a fundamental announcement day where there is no consolidation. Turn your computer on once again. The term convergence means a location where there is more than one hidden educated reason for the market to bounce, i.e. a trend line, a fib number, a bell curve. Rules to trading fundamentals and convergences are this. Go to forextips.com, find that fundamental announcements. Now, go and find all your consolidation, all your trend lines, all your inner outer long-term trend lines. Pull out that trader's checklist. Determine if you're in an uptrend, a downtrend, or if the market is potentially reversing. Find all your anticipated trend line bounces and potential convergences. Find where the last level of support is for your stop orders and resistance. To understand how the game is played, Lesson 2, if the potential stop loss order is too great in your strategy, you may want to pass on the trade. Pull that trader's checklist out and follow that trade. But here we have gone to forextips.com. We found that there's a fundamental announcement, and we start doing our homework because we can't find consolidation. Here's the homework we do. We draw an inner trend line and an outer trend line. It appears as though the inner trend line has been broken. Remember, when the inner trend line is broken, it has a tendency to go to the outer trend line. We then draw our new down outer trend line. Because a fundamental announcement is going to take place in 15 minutes, one of two things are going to take place. The market is going to rally to the north and blow through this trend line and take out this high and that high, or it's going to rally and bounce off of this trend line and fall. How I look at it is this. I can either do one of two things. I can buy this low if it bounced off the 382 from this last down price swing, which is taught in Lesson 7, or I can short this bounce because I now see that I'm in a downtrend. You may want to use your indicators to see which way the market is going. Be that as it may, my strategy is to short the trend line because When inner trend lines are broken, they predominantly move to the outer trend line. I'm going to short this new trend line. I'm drawing my Fibonacci's. I can see that right there at the trend line, if the market were to rally here, is a 618, and that it should bounce there, and if it does, it should fall to at least the 1.618, but I'm not going to be surprised if it blows through this trend line because I'm on a fundamental announcement day. Fundamental announcements are the fuel that move the market. If I am wrong, my protective stop loss order, it looks like, is about 35, 40 pips away. Risk against reward. Look at how I'm risking 30, 40 pips to potentially capture maybe 100 pips. Fill out your paperwork, find all your levels of support and resistance, fill in the blanks for you to place your trade. Now look at how the market has rallied up and hit the trend line and hit the 618. I am selling the 618 trend line right before the announcement. You project the profit to go to the 1.618 extension, which is, let's look at this, approximately almost 90 pips away. I can cancel, replace this because I'm on a fundamental announcement day. It wouldn't surprise me if this market goes 120 pips, 150 pips. It could go through this trend line extension. Let's see what happens. Now, the reason we want to trade that 618, 786 Fibonacci bounce in the direction of the trend is because if our trade doesn't work out, our losses will be small. Look at how the market bounced there and just blew through that 1.618 extension and went straight to the 2.618 extension and stopped. Trending days trend down. They do not return back to the opening price. Look at how the fundamental announcement moved this approximately 120 pips in a short period of time. Your software monitors your P&L statement, but still please figure out your P&L on what you made as you paper trade and print out your chart to keep a record. Now remember the rules to trading on a trading day. Remember the rules to trading the straddle. Remember the rules to trading convergences on trending days. Here they all are. Practice them, study them. Let's all agree you got to have an edge. You got to know where to get in and get out. You got to know the difference between a trading day and a trending day, and how to trade a straddle on a trending day or convergences on a trending day, and how to trade that upper lower bell curve on a trading day. You got to learn how to manage that risk. Did this lesson teach you the difference between a trading day and a trending day? Did this lesson teach you where to look for fundamental announcements, how to find consolidation and sideways movements, how to straddle that consolidation? Did it teach you how to trade convergences on fundamental announcement days and how to place those orders 15 minutes right before the announcement, and how to avoid bull and bear traps, as well as protective stop loss orders, where to place them, and how to financially protect yourself in every trade? If it didn't, replay the lesson over and over again to avoid being one of the failures, because the reality is this: 90% of all novice traders fail. Remember, successful traders will do what unsuccessful traders won't do. Successful traders study and practice and learn. There's two ways to learn in this business. One is try to become lucky. But if you become lucky without education, it'll only be a matter of time that you'll become unlucky. The second way is to acquire a mentor. Market Traders is a mentor. ForexTips.com, we're mentors, we're coaches. We push you in the right direction. We show you where the gold mine is. Learning to trade from a mentor or from a coach is like buying a map to a gold mine. It'll save you a lot of anguish, a lot of frustration. Why? Because we all want the market to move in our direction from entry. Education on how the market works improves those percentages. There's 16 lessons on trading the Forex that can help you. They can help you in your other financial products that you trade. They all come with trading exercises. Please buy into your trader's mantra. The market must meet your criteria or you should not trade. And remember, if the chart is not clear and doesn't visually make sense, when in doubt, stay out. Because of the 21-day 3% rule, play this lesson over and over and over again. Buy into a clear set of rules that make sense to you, and place yourself in a position to be operating from 85 to 95% recall prior to trading, or don't trade. And on behalf of everybody here at Market Traders Institute and ForexTips.com, we commend you on investing in yourself, your financial portfolio, your family, those who you have a stewardship and responsibility to managing funds, your hard-earned money. They thank you for investing in yourself and educating yourself and purchasing this lesson well before you trade. Thank you.